G'day, fools. I'm Scott Phillips, the Motley Fool's Chief Investment Officer down here in Australia, and I'm joined by our Director of Research, Kevin Gandiya. How are you, buddy?
Hey, Scott. I'm very well. Thanks for having me.
Mate, thank you for joining us. I love this segment. I think this is actually the favorite video we do amongst the investing team. I'm not sure it's the same for you, but we're all kind of book nerds, right? We're all reading nerds, although I do know, like me, I assume, post-kids, the reading slows down a little bit, so we've had to drag back a little bit to some of the past reading. Our time is not our own quite so much with kids, but such is life. Mate, this is our favorite investing books where we ask the analyst team to come with the books they like, they want to share with our viewing audience here on our YouTube channel, basically to give people some reading ideas. And it's just before Christmas, so either if you're looking for a gift or you're looking for some summer reading, there is no better place than our favorite investment books series. By the way, quick tip, if this is the first one of these you're seeing, we have playlists down on our homepage on our YouTube channel. So go to YouTube, I said fool, go to youtube.com/c/foolau. I believe C is channel, but I'm not sure. Anyway, so it's youtube.com/c/foolau. You're already there. But if you go back to the homepage, if you're seeing this video elsewhere, you'll see our playlists below that. And we've got, must be 8 or 10 now, I think, books that the team have reviewed, which I thoroughly recommend. Now, Kevin, you're in charge of the investing team. You are our Director of Research. And you've bought me a book that I first heard about from our CEO, Tom Gardner. It is called The Davis Dynasty. And it was a really remarkable book. I won't say completely formative, but it was a pretty important book in my own investing, my own approach to the advice we give our members. Tell us about the Davis Dynasty.
Yes, Scott, this is a book that we actually give to every single investing analyst who joins us at the Motley Fool. So that tells you how highly we rate the book, not necessarily for the quantitative investment themes within the book, but more for the mindset aspects that are really developed within the book. So we think when we look at investing, you can know all the technical aspects about what a company is, or what its valuation is, what its growth prospects are. But if you don't have the right mindset supporting your investment philosophy, then it's really difficult over longer periods of time to consistently do well in the market. So mindset is quite important for us. And this book, The Davis Dynasty, 50 Years of Successful Investing on Wall Street, really focuses on a particular gentleman and his family. Shelby Davis is his name. He had a son also called Shelby Davis, so it is a bit confusing. But across 3 generations, with himself, his son, and then eventually his grandchildren, they managed to successfully invest $50,000. This was around 1947, I believe, just after World War II. $50,000 then turned into over $900 million by 1994, which is just spectacular returns. Took them half a century, but a lot of money and a big return for that family.
Mate, it was well and truly worth waiting for when that's the kind of offer at the end. The coolest thing about investing maybe is the best years of compounding are the years after we're no longer here, unfortunately. Because if you could let compounding go for 50 or 70 or 100 years, the returns are spectacular. It also reminds me of that great old, I'm pretty sure it's a Greek proverb, that a society grows great when old men plant trees under whose shade they will not sit. And I just like that idea. I think this is kind of the same kind of idea, right? This is not necessarily about intergenerational investing, though if our viewers are in the position to do that, we'd highly recommend helping your grandkids out and their kids, because that's where it really does turn into some serious coin. But it is, as you say, mate, about the mindset. People interview entrepreneurs all the time and they say, oh, look, I just worked hard. That's how I did it. I'm like, no, working hard is necessary, but it's not enough. And I feel like to some degree, as you say, knowing the numbers, knowing how to read a balance sheet, knowing how to think about business models, that's important, right? But it's not enough, because if you know that stuff, but not the other bits, it really can bring you undone. Shades of long-term capital management who had, was it 12 Nobel laureates, I think, on staff and still managed to go broke. So it is that mindset that is so important for us at the Fool. Mate, tell us a little bit about the Davis Dynasty, a bit about some of the lessons you took from the book over that 50-year period.
Yeah, so it was really quite interesting. I think the first lesson was just that dedication towards investing, just making that decision to be a dedicated full-time investor is really quite important. You don't necessarily have to quit your job. So this gentleman, Shelby Davis, was an American bureaucrat. He actually quit his job and decided to focus full-time on investing. So I don't think every investor actually needs to do that. But I do think it's important to take it quite seriously and to just have that ongoing dedication. I think compounding works not just with money or with time, but also just compounding of knowledge and skills and expertise. And so if you just take that decision to actually just learn a little bit every day, read as much as you can, listen to different experienced investors are saying. You'll be surprised how much knowledge you can build up over very long periods of time. So that's the first thing that comes to mind. The second thing as well is just that long-term aspect. So, Shelby Davis was really focused on investing for the long term. So he just made a personal decision never to sell unless if the business fundamentals had actually changed. So he would just look at how well is the business performing? Do I still trust this management team? Is this company still well positioned within its industry and market to continue doing well over time? And as long as all those factors were still in place, he just decided to hold and hold and hold and hold. So he actually looked at his stocks, his investments, more the same way that most people out there would look at their houses, for example, or if they're business owners, they're small businesses, not necessarily looking to trade in and out of it on a day-to-day basis, but just looking at the longer term. So if you or most people, if you own a house, for example, you're not necessarily looking to buy and sell as the market changes within your suburb. You're just looking for a place for your family to live, usually for a longer period of time. If you've got a small business, that's where you're earning your income, and you're not necessarily looking to trade in and out of a cafe that you own or whatever the case is. You're looking to hold that business. So he had a very similar mindset to his stock portfolio and his investments, and I think that's actually quite useful for that as well. The other thing I found particularly interesting was his focus on companies that did very well in that particular time and he really particularly focused on insurance companies. I don't necessarily think, focusing on insurance as an industry is maybe a game-changing strategy doing it now. But I think if you think about the context of the times, this was the 1940s. Even a gentleman by the name of Warren Buffett has done well investing in insurance companies. So just looking at the zeitgeist, the companies that are actually doing well in that particular era, and focusing on those companies, I think the message there is to focus on very strong industries with strong tailwinds for growth. And that has really did well for him. I think the other thing as well is just a focus on pricing as well, something we don't necessarily discuss as much these days, as asset prices are quite high. So he was quite moderate about how he invested into companies. So he wasn't necessarily just gung-ho on investing in the most expensive companies out there, but also he wasn't necessarily looking at cheap stocks either. So he believed that business fundamentals are reflected to some extent within the pricing. So sometimes if a company is too cheap, maybe it's cheap for a reason. So he wasn't necessarily jumping into the cheapest thing he could find, but also he wasn't willing to pay any price whatsoever for a business. So again, just that long-term focus, business fundamental driven investing philosophy was really the key behind his approach. And then just adding time to that. So just buying stocks, he was just a net buyer of stocks over time, and just adding time to that was very instrumental in adding that compounding effect. He really allowed compounding to work very well for his portfolio.
Phil, you're watching this on YouTube, go back a minute and rewatch the last minute of what Kevin just said, because that is a wonderful summary of understanding the businesses you're buying, the prices you're paying, and the time that it takes for that to compound. And I'm not going to be able to repeat it as well as Kevin said it. So go on, drag your little slider back about a minute, watch that again. Promise it'll be worth it. So if you can internalize that, that's super valuable. KJ, it also, your point about insurance companies, we all know that was true of Shelby Davis and of Warren Buffett. And I think, and we kind of think about time having moved on, and so the new industries out there now. Those things are true. What I like also about the way you put that when you described it a little bit earlier was the transition from the at the time businesses. It's almost impossible for us to really put ourselves in the time and place of Davis's investments or Buffett's investments. But if we think about insurance companies today, we think big, lumbering, okay returns maybe in some good years, natural disasters all around the place, boring, slow, old, well-priced, well-understood businesses. And you think, why was Warren Buffett buying those? Or maybe, sure, it was okay back then to buy those sort of businesses. They weren't those sort of businesses back then. Maybe that is the kind of key point. And I think it's not a new thought, but you just phrased it beautifully. And immediately in my head, I was straight back to that idea of, at that time, they were the ones worth buying. I think it's Phil Fisher's book as well, written in the 70s. And even Peter Lynch's, I think, in the early 80s or about the early 80s, gives you similar stories. And it's so easy to dismiss them and say, that was then, or they're boring companies. And they are now, because we're looking at them 30, 40, 50, 70 years later and saying, well, we know how the story played out. Putting ourselves in that position on that time and saying, take the principle, take the idea, take the lesson, not the example that's being used. So many people in all sorts of life, in investing, God knows, in social media. But, you're trying to discuss a topic or a principle, and as soon as you give an example, people get stuck on that example, and they can't move themselves away from that to what's the principle being discussed, what's the idea or the concept being talked about, independently of the example. And I think that's so valuable, mate. So thank you for spending some time with us. Did you leave anything out, or have you covered enough detail? You've done a spectacular job. Was there anything else you want to add, or are we finished, do you reckon?
I think we've covered it all. I mean, here's the
Beautiful.
book right here.
There you go.
I normally try to keep, audio copies or just electronic copies of books. But I think with the book this special, I think you almost need a physical copy just to keep it on your shelf and occasionally just have a look at it again. Sometimes it's quite difficult, especially as you're going through the day-to-day. Just the differences of life every day and just the different headlines that you see in the news. Sometimes it's hard to get that longer term aspect. So it's good to have a physical reminder in your office or just in your home shelf somewhere that just reminds you that there are people out there, investors who have really dedicated themselves to the game and they've really done so well just by teaching themselves, teaching their children, just maintaining that long-term aspect and just looking for good companies that you can invest in over and over again over long periods of time. And if you keep those very simplistic but hard to, sustain principles, then I think you can actually do very well in investing. And that's all really what we're all trying to do with our own personal portfolios.
I love it, KG. Mate, can I make one last point before we finish up? Because there's one thing I want to go back to. I know you made a very clear point, and I know what you mean. You know what you mean. Our viewers almost all know what you mean. But for the couple out there who heard about Shelby Davis giving up a job and going trading for a living, he wasn't writing a spreadsheet. He wasn't day trading. He didn't have his brokerage account in front of him. And he wasn't, making furious trades, trying to guess the position of the market. When Kevin says he gave up his job to invest, he literally means invest. That is, do your research, make your regular long-term investments. We're not for a second saying you should or could. Maybe you shouldn't even give up your actual current day job, by the way, because you can, as long as you put enough money or time in investing, do both. But don't give up your job and go day trading. Please don't do that. We don't mean that. There's a difference between investing and trading. Very clear to us, very clear to Kevin. He made a perfect point. But I just want to double underscore that, mate, because last thing I want is people saying, I work for Shelby Davis, I'm going to give up and, grab a laptop and a computer and go sit in a cafe and trade oil futures or God knows what people do these days. So I hope you don't mind me just adding that at the end. But as you were saying, I thought I must come back to that. So an important point. By all means, invest. By all means, dedicate a whole lot of time to investing. But investing is not trading. Trading is not investing. And that's an important one as well. Kevin, thank you for spending your time with us. Thank you for sharing your knowledge. And thank you for sharing the Davis Dynasty. This is one I've read. We went a decent stretch with books I hadn't yet read. So I'm both happy I've already read the book. I'm frankly also happy I'd have to add it to my reading list because it gets longer every week. But a really, really good book. I can absolutely concur with Kevin's observations. And it's just a really good thing to go back sometimes and remind yourself of the really important fundamental things that do make a difference. So, KJ, thank you for your time. Viewers, thank you for spending some time with us. We hope you're finding this series useful. I hope you're adding some stuff to your summer reading list or to your Christmas list or whatever you want to do with it. We hope you're finding some better books to read because at the end of the day, yes, we absolutely make stock picks. We give you those stock picks if you're members of our services. We say, hey, here's some stocks we think you should buy. But we also try and make you better investors. We try and give you a fish and teach you how to fish. And that's what this segment is all about. So with no further ado, from Kevin, myself, and the whole Motley full team, until next time, full on.